This video might be long, and if you know what options are, you might think that they're scary and confusing. So before I even talk about what an option is, the first point I want to drive home is that you probably want to learn about them. It sounds ridiculous, but most people give up on options simply because they aren't properly motivated. So I've narrowed things down to the four biggest reasons why I believe options are so powerful. I'll go through these first so you can decide if you think it's worth your time and effort. Okay, so first, make money in any market. I mean any market. Bull market, bear market, volatile market, even flat market. You can make money from prices simply staying flat. Now, devil's advocate would point out that you can also lose money in any market. While this is true, the most important part is about control. You get to be the one dictating your profits instead of being at the whim of the market. For example, this is a look at the S&P 500 from the mid-90s to mid-20 teens. You can be permanently bullish on the US stock market, and it's probably not a bad bet given its resilience in the past. But nonetheless, there is sometimes pain in the uphill climb. If the only way you can make money is by stocks going up, then the popping dot-com bubble of 2000 and the subprime mortgage crisis of 2008 were long and difficult. While we can't change the market, we can certainly react to it. Bullish positions are often best long term, but it's nice to have options in your tool belt to deal with recessions and other uncertain markets. Next, articulating your theories. Articulation is difficult without options. If you just buy a stock, what does that really mean? Do you think it's going to go up tomorrow or in 10 years from now? Or maybe you think it might stay flat, but you'll just collect the dividend. It's not very obvious by just looking at the trade. People often believe very specific things, and options allow you to bet on or against specific things. Imagine an earnings report is coming up, and you think a stock may go up or down, but won't stay the same. Imagine you think a stock could stay the same or go down, but won't go up. What if you think a stock has long-term potential, but may currently be in a speculative bubble? These are all really tough to articulate with traditional stock buying or short selling, but very easy with option trading. Next, opening the full risk-reward spectrum. So when you typically imagine how the risk-reward spectrum looks, you might think of something along these lines, where bonds and well-diversified funds are less risky, while penny stocks and crypto are more risky. This begs the question, where do options fall on this list? And as you might be able to guess, the answer is the entire thing, and extending far beyond in both directions. That's why I've worded it as opening up the full spectrum, as you don't fully understand how safe or dangerous a trade can be until you've started trading options. For example, every single day there are options that experience triple-digit percentage gains, and very often quadruple-digit percentage gains. I've even seen a few rare instances where options have made quintuple-digit percentage gains in one day. This kind of thing is completely unheard of, even in the crypto world. Now granted, these kinds of trades are incredibly risky, and I wouldn't recommend entering anything that could make that much money. But it just illustrates how powerful options can be. Whatever your risk tolerance is, you can generate an options portfolio surrounding it. Now, the fourth and final point, all stock trades could have been an option trade that would have made you more money. Now granted, hindsight is 2020, but this is easier to engineer than you might expect, especially when entering or exiting positions in 100-share increments. So that's my pitch. If you're still here, that means you're ready to learn. So grab a pencil, some paper, and maybe a snack as well, and we'll dive right in. So, what is an option? We'll take the definition step by step. It's a contract. That's all. You could think of it like a legal piece of paper that gives you the right but not the obligation. That's just a fancy way of saying you can do something but don't have to trade 100 shares, everything with options is in 100-share increments, of a given stock at a specified strike price by some chosen date in the future. And that's it. That's the full definition. So if you're a genius, then everything to do with options should make perfect sense to you and you don't need to watch the rest of the video. But for the rest of us, we'll go step by step through what this really means to make more sense of it. So let's start by identifying the variables, because there are 4 of them. First, trade. What does that mean? It's either going to be buy or sell. Depending on which one it is, it'll have a different name. The right to buy is called a call, and the right to sell is called a put. We'll talk more about those later, but just know that those are the options for now. So next, a given stock. Technically, you can have options markets trading on things that aren't stocks, but they're easiest for our examples. Since options are a derivative market, they're best for stocks with high trading volumes. Anything with $1 billion or higher market cap will usually at least have a viable options market, but they're usually best for large or mega caps. So now, stock price. This could really be any dollar amount. They're usually going to trade in finite increments. Depending on the stock, it might be 50-cent increments or $10 increments. The options that are most relevant are the ones that have strike prices relatively close to the price that the stock is trading at, but far away prices often trade too. Lastly, the expiration date. Options expire at the end of the market week, so usually 4 p.m. on Fridays, and options trade right up until they expire. So if you have an option, its expiration might be days, weeks, months, or years away. Options trade at all kinds of time periods. So that's really it for the definition. If you were to step through these variables and plug in reasonable values based on the guidelines we've talked about, you would probably have to find a real option trading out there in the market right now. So let's step through an example. So in our example, we'll be using Apple, and right now Apple is trading at about $290 per share. So we'll assume that's the trading price for the example. For those watching this video in the future, that number is probably laughably different from what it will be, but that's what we'll work with for now. Anyway, let's just fill in our variables with some reasonable numbers. We'll say that this is a right to buy contract. So the name of this type of contract is a call. Buy 100 shares of Apple at $295 per share. So you'll notice our strike price is higher than the price Apple is trading at. And we'll use the easiest expiration date, which is right now. We'll say the option is just about to expire. So this begs the question, how much would this option be worth? If you want to think about the answer, feel free to pause the video right now and try to figure it out. But after some thought, you'll notice the answer is just $0. Remember, the entire world is trading Apple at $290. So a contract that gives the right to buy it at a higher price isn't anything valuable, so it would just be worthless. Also keep in mind the option can't have a negative value. It's not forcing you to buy at $295, just giving you the option. So worst comes to worst, you can always just throw it in the garbage with no strings attached. When a call has a strike price higher than the trading price of the stock, this is called being out of the money, as the contract has no intrinsic worth. Now let's change things up a little bit. We'll ask the same question, but change the strike price of the contract to $285 per share. Now pause your video, see if you can figure out how much this contract would be worth, as this question has a real answer this time. So if you were able to get $500, good job. Now it's a different story. The rest of the world has to buy Apple at $290 per share, but holding this contract gives you the special ability to buy 100 shares at a lower price. So if you wanted to, you could exercise the contract, paying $28,500 for 100 shares of Apple, and then immediately sell those 100 shares on the market for $29,000, keeping the additional $500 as profit. Since this contract gives you the ability to instantly profit $500, that's its intrinsic value. With a strike price lower than the stock, this call is said to be in the money. Now we'll change gears a little bit. Let's adjust the strike price back to $295, but also change the expiration to 1 week from today. We'll ask the simpler question, would this contract be worth anything at all? And the answer is yes, it absolutely is worth something. It seems kind of strange since the strike price is more expensive, but the easier way to see why this is true is proof by contradiction. Let's imagine we say no, this contract isn't worth anything, so we'd happily throw it in the garbage immediately. Then over the course of the next week, Apple's share price rises to $300. We would basically have just thrown away $500 because that's what the contract ended up being worth at the end of the week. Now granted, this is unlikely to happen, but it certainly isn't impossible. And it's also not the most extreme case, as Apple could rise far above $300, making the contract worth even more. The lesson here is that a contract will have value if there is a reasonable chance it could end up in the money before the expiration date. This is called time value, or time premium. It's a little bit more complicated to calculate exactly what this contract should be worth, and we'll talk about that later, but it will have some real value. So we can make a little table here. If an option is in the money and it expires in the future, it's going to have intrinsic value, meaning you could exercise it and flip it on the market for profit, and time value, meaning that it could still be worth more in the future. If an option is out of the money and expires in the future, then its worth is only made up of time premium. If an option expires immediately and it's in the money, then we know it's worth exactly the intrinsic value, or just the difference between the strike price and the market price multiplied by 100. And lastly, if an option is out of the money and expires immediately, it's completely worthless. We haven't yet talked about how to calculate time premium, but if at least classifying options into this table doesn't make sense to you, step back through the previous examples until it does. This is the foundation of options, and it's very important to understand before moving forward. So now we're going to talk about puts, or right to sell contracts. We'll use an almost identical example as the previous one, but with the right to sell Apple at a strike price of $285 per share. How much would this contract be worth? So here the answer would be $0. It's a little bit confusing since it's backwards from calls, but this option is actually out of the money. If the rest of the world can sell Apple at $290 per share, it's nothing special that we have the ability to sell it at a lower price. In the same sense, if the strike price were $295, the option would have an intrinsic value of $500 because you could buy 100 shares from the market for $29,000 and then instantly exercise the option to sell them for $29,500, profiting $500. Likewise, we can mirror the time premium example as well. The ability to sell Apple at $285 per share might not be very special right now, but it could be in a week if Apple were to drop to something like $280. So, in summary, why would someone buy a call? They think the underlying stock will go up. And conversely, why would someone buy a put? They think the underlying stock will go down. It's really that simple. So, this is what a happy path would look like for bullish and bearish traders. When the underlying stock goes in their desired direction, their contract will become more valuable. It might go from far out of the money to close to the money. It might go from out of the money to in the money. It may even go from in the money to deeper in the money. It doesn't really matter. As long as there's time remaining, the value will be driven up, and much more sharply than the movement of the stock. If shareholders make 5%, call holders might make 50%. Now, the obvious risk is that if shareholders were to lose 5%, call holders might lose close to 100%, but put holders might make 50%. The risk-reward ratio for option holders is obviously much higher here. But here's the important part. These traders probably don't intend to ever end up with 100 shares, and maybe even can't afford to. As long as there are traders somewhere in the market who can afford 100 shares, the contract values will stay fair and traders can simply siphon off movements in their value without caring too much about what the contract itself promises. But this begs the question of where these traders fit into the life of the option. It seems pretty straightforward. They pay some money, and they get the contract in return. And then they sell the contract and get some money in return, hopefully to make a profit. But who are they making the trades with? The answer is probably other traders, just like them, looking to turn the contract for a profit. And they're doing the same with other traders, so on and so forth. But where does the option come from? It has to have a start and an end. There has to be a first trader who started with the option, and a last trader who ended up with it during expiration. And these traders have very special roles. The intermediary traders can just flip the contract without worrying about what it promises, but the first and last trader may very well end up interfacing with the 100 shares. Let's talk about the last trader, since that's a little bit easier. They can always just scrap the contract if they want, and they probably will if it expires out of the money. But if it's in the money at expiration, they're going to exercise it since it has value. But how is that possible? If the whole world is trading at the market price, who is giving them the ability to trade at a better price? The answer, as you might imagine, is the first trader who initially sold the contract. Remember, if you are buying the right to do something, that means somebody else has sold their right. They are the ones who have the obligation to fulfill the contract, and they have simply sold it for cash. This is called selling covered options. The life of all options begin when a trader sells covered. You can sell covered calls or covered puts, but we'll talk about calls first. In order for a trader to sell a covered call, they must already own 100 shares of the underlying stock. Upon submitting the order for the trade, they will typically need to hand those shares to their broker as collateral to make sure the contract can be fulfilled properly. When the order completes and the call is sold, the seller will immediately collect the cash, no matter what happens. The only variable is to find out what will happen to the shares. If the contract expires out of the money, then nobody will exercise it. As a result, the broker will give the collateral back to the seller and they will keep their shares. If the contract expires in the money, whoever is holding it will exercise the contract, and the sale will take place at the agreed upon strike price. The seller will not get their shares back, but will receive the cash from the sale, the amount being exactly 100 times the strike price. Selling covered puts is the same sort of idea, only backwards. The seller does not need 100 shares, but instead needs 100 shares worth of cash at the specified strike price. The broker holds this cash as collateral when the sell order is submitted. When the order goes through, once again, the seller immediately gets the cash from sale. If the option ends up out of the money, the broker will give the cash collateral back to the seller. If it ends up in the money, the purchase will take place at the strike price, and the seller will get the 100 shares instead. So we already know that someone will buy a call if they think the stock is going up, or they would buy a put if they think the stock is going down. But why would someone sell a covered call? This question is a little bit harder to answer. We know the person buying the call wants the stock to go up. If they could choose, they would maximize their gain if the stock price went to infinity. Typically, people on the opposite sides of a deal have a direct conflict of interest. So shouldn't this imply that the seller hopes the stock goes to zero? Well, no, that wouldn't make any sense since the seller owns 100 shares of the stock. If it went to zero, they would lose their shirts. The real answer is interesting. They're best suited if the stock ends up close to the strike price of the call. Now, the strike price of the call might be above or below the trading price of the stock. So a covered call seller might want the stock to go up, or they might want it to go down. The reality is that the real conflict of interest is with the last person holding the contract, not the first person it is sold to. The person exercising the option will make the choice that is worst for the original seller. If the strike price and market price are similar, the seller doesn't really care what they end up with, since the cash and shares have roughly the same worth. They could easily make the opposite trade with little to no losses after the contract expires. If a shareholder is selling an out-of-the-money covered call, that means they probably prefer to hold the shares. They think the stock might go up slightly, and they're simply collecting some additional cash on the side by selling the contract. If they sell an in-the-money covered call, that means they're probably looking to exit their position. Even though the strike price is less than the market price with the contract money thrown on top, they will always profit more than just selling the shares on the market. So why would someone sell a covered put? Weirdly enough, the answer is exactly the same. Once again, put sellers may prefer the stock to go up or down. Selling an out-of-the-money covered put means that somebody is likely just looking to make some cash and probably doesn't want to end up with the shares. Selling an in-the-money put means that somebody is likely looking to enter a position, but can do so in a cheaper way than just buying at market price. This might seem confusing as it's all just hypothetical, but will probably make much more sense with a concrete example. Let's say once again that Apple is trading at $290 per share, and we'll say our trader doesn't want to own any shares, but at least think Apple will hold its price. Maybe go up, but at least hold its price. They decide to sell a covered put. They choose $285 as the strike price. Even though they think Apple will hold $290, they'd prefer to not end up with the shares, so they keep some buffer space. I've looked up a real market price for this contract, and it would trade at around $7.55 per share, or $755 total. They aren't picky on the time frame, but choose 1 month as a moderate, medium-term choice. They post $28,500 as collateral and collect $755 immediately as cash. The buyer is really banking on Apple falling. It would have to go below $285 to be worth anything, and since the buyer is forking up $755, would have to go as low as $277.45 for the intrinsic value to break even with the buyer's price. We'll talk about option pricing later, but the basic reason why the option is so expensive is because Apple is expected to be volatile, and it wouldn't be too crazy for Apple to drop $13 in 1 month. While this is still unlikely, the potential reward is pretty lucrative for the buyer. $270 would give them 100% gain, $262 would be 200%, and so on. For put buyers, profiting is unlikely but very strong when it happens. But anyway, let's get back to the seller. If Apple goes under $285, the seller would have been wrong about it holding, and they will end up with the shares. This isn't the end of the world because they can sell them. But if it continues under $277.45, selling the shares would lose more money than the contract gained, and this is the point where it becomes a net loss. If Apple stays over $285, the seller will get their collateral back. Granted, if Apple goes to $286 or $1,000, it doesn't really matter to the seller, and they make the exact same amount of money. The issue is missed opportunity. The seller could have gone with a much more expensive put and made more money. The net result is sort of interesting. If you consider the money held as collateral to be part of the position, and the collateral and sale transactions happened at the same time, then receiving $755 at the same time as paying $28,500 would be like depositing $27,745 into the position and then getting the full $28,500 back a month later. While this does only equate to a 2.7% gain, 1 month is a very short time to make this kind of money. 2.7% compounded monthly gives you a 38% gain yearly at that rate. Not too bad considering you're betting on something that is most likely going to happen. The only reason why the option buyer's potential gains are so much higher is because their position is much less likely to become a success. Now let's look at a new scenario, this time where the trader would prefer to end up with 100 shares of Apple. Again, they sell a covered put, but this time in the money. This put is much more expensive, as it's more likely to expire valuable. They post their collateral and collect the cash from the option sale. If Apple stays under $295, which is most likely, they will end up with the shares as intended. Given that they bought Apple at $295 but collected $1,248, it would be as if the average buying price were $282.52, which is pretty good considering Apple was trading at $290 for the rest of the world. Now sure, it'll be a net loss if Apple goes under $282.52 per share, but keep in mind, this trader wanted to own 100 shares of Apple. Their alternative would be to buy them at a market price of $290. No matter how low below the break-even Apple goes, the trader would be better off entering via the put instead of just buying the shares at market. Now if Apple goes over $295, the seller will not get the shares, but this scenario is still really good for them. Similar to the math in the last scenario, this is much better and technically the best case for the trader. The only stress of Apple going too high is the missed opportunity. For example, if Apple were to continue over $302.48, the seller would have made more money if they just bought the shares at the market price of $290. Alternatively, they could have sold an even more expensive covered put. I won't go through full examples for selling covered calls since they're basically the exact same thing, but you could imagine how a trader might use them to either make money on top of owning their shares or use a covered call to exit a position at a favorable price. So a natural question that may come up, what happens if a covered option seller changes their mind? And the answer is, they can. All they need to do is buy out their option. They get their collateral back and no longer have any obligation. In fact, a common way for traders to make money is to sell an option and then buy it back at a cheaper price, as backwards as that sounds. In that sense, selling covered options are often portrayed as negative. For example, if you're an option buyer, you start with 0 contracts, and then you buy one, so you have 1, and then you sell it, so you have 0 again. If you're a covered option seller, you also start with 0, but you sell one, so you have -1, and negative counts require collateral. And just as easily, you can buy it again, and you'll be back at 0 to get your collateral back. This brings up the interesting point that context doesn't really matter for option pricing. If you're selling an option that you already have, or selling a covered option, it's the exact same market, and the person on the other end of the deal won't know the difference, and there's no reason they would need to. Same thing applies for buying an option you want to own versus buying out an option you've previously sold. So to summarize what we've talked about so far, buying options is less likely to make you money, but the amount of money could be much larger. And initially contracts are relatively cheap, so basically anyone can do it. For selling covered options, you're more likely to make a profit, but it's usually a more reasonable amount. The main issue with selling covered is that it just requires so much capital for collateral, since 100 shares is usually a lot of money and it may be out of reach for most people. A common question people ask is what good alternatives there are for people who can't afford to post large amounts of collateral, but want similar profit opportunities. There's really one good answer and one bad answer. We'll talk about the bad answer first, and that is selling naked options. This is such a bad topic, I almost prefer to leave it out of the video, as it may do more harm than good. But selling naked options is the same thing as selling covered options without the collateral. This is not a common practice. A lot of brokers don't allow it, and the ones that do usually only allow it for very experienced options traders. Not only can you lose more than 100% of your bet, but there's actually no limit to how much money you can lose. To make it even worse, selling naked is instant profit for no collateral. So if people start to lose money on naked options, they can open more naked options to cover, and it creates a vicious cycle. I'm not aware of any financial instrument that is riskier, and obviously I don't ever recommend doing this. The other option, credit spreads, is light years safer, and this is actually my favorite financial instrument. A credit spread is just a combination of options. We've covered the basics for single options, and credit spreads are a good transition into the next phase of this video, where we'll talk about different ways that you can combine options to make higher level financial instruments. As you might imagine, there are call credit spreads and put credit spreads, but we'll start with call credit for the time being. The first thing you do is buy a call, pretty simple. Next, you're going to sell a call with a lower strike price. Now this might seem odd, as we've already talked about how you need 100 shares to sell a covered call. But lucky for you, you already own a contract that gives you the right to buy 100 shares at a fixed price. Therefore, you can use the first call and a small amount of cash to serve as collateral for the sale. For example, if the difference between the strike prices of the two contracts is only $1, then you would only need to post $100 in collateral. This is because no matter what happens to the value of the stock, the call you're selling can never be worth more than $100 more than the call you've posted as collateral. So you can probably see where this is going next. You hope that both calls go to 0. because if the calls go to zero, that means there's no spread between them and you can get your cash collateral back. You won't get the call back, but it was really just used as a hedge against large movements anyway. Call credit spreads are a bearish instrument, so you typically profit when the stock goes down, but it's very easy to set them up so you'll profit if the stock stays the same or even goes up slightly. In this sense, you're profiting in the majority of cases, similar to selling covered calls. It might still be confusing, but it should make more sense after a real-world example. So let's say a trader is reasonably bearish on Apple, but isn't willing to buy a put because they know they'll lose money if Apple stays the same, which they also think is totally possible. So a great alternative here is a call credit spread. They start by buying a 1-month call with a $300 strike price for $5.90 per share, or $590 total. They then sell a 1-month call with a $295 strike price for $7.88 per share, or $788 total. But of course, they will need collateral for that. The $300 strike price call and $500 in cash will be used as collateral. The cash amount is $500 because the strike prices are $5 apart. So you need to post $5 per share for 100 shares. So they've now successfully entered the position and they've thrown a lot of money around. So let's do some math to see what they've actually paid for this spread. So first they spent $590 for the contract, and then they collected $788 for the second contract. But then they had to post $500 as collateral. So all in all, they spent $302 to enter this position. If Apple stays below $295, both calls will go to zero. Most importantly, the one they have sold will not be exercised. As a result, the trader will get their $500 back. So they spent $302 to enter the position, and it paid out $500 after a month. So their total profit is $198. Now let's talk about the worst case scenario. If Apple were to go over $300, both calls would be in the money, and as a result, the call sold will be exercised. The broker will need to use the collateral to fulfill the contract, and the trader won't get any back as a result. It doesn't matter if Apple goes to $301 or $1,000. The difference between the contracts at expiration will be exactly $500, which is the collateral that they posted. In this case, they would simply lose the $302. Now, it is true that you can lose more money than you can gain in this situation, but those are simply the odds you get when you're betting on something that is most likely going to happen. So you can imagine how a put credit spread would be the opposite. It's the bullish form of spread, and in a similar way can be used to make money when a stock stays the same or goes up. I won't go step by step through this example since it's very similar to the previous one, and I think you can probably get to these results on your own. So this begs the natural question, what is the opposite of a credit spread? And the answer is a debit spread. Instead of buying the cheaper option and selling the more expensive one as we've done with credit spreads, you do the opposite. You buy the more expensive one and sell the cheaper one. That is where the name credit and debit come from. I don't think it's even worth stepping through the examples of these because they're basically the exact opposite of credit spreads. If you're curious, you can step through the previous examples and just imagine you're taking the opposite side of the trader. Max gain, max loss, chance of profit, etc. Everything is exactly flipped. So moving on, strangles are the next topic. This one is perhaps a little bit simpler as they don't involve selling anything with collateral, although the use case is a little bit more extreme. Just as last time, the first step is to buy a call, but the second step is to buy a put. And that's it. You're essentially banking on severe volatility in a stock's future without having to know what direction it will favor. If the stock were to go up, then so would the call. Hopefully the gains from the call will be enough to cover the losses from the put plus additional profit. If the stock falls, then hopefully the gains from the put will cover the call losses plus additional profit. The worst case here is if the stock doesn't move very much. Then at least one, but probably both contracts will lose value and the trader will experience a net loss. Strangles take advantage of the fact that options have nearly unlimited upside, while the worst that can happen is they go to $0. So if you're predicting a big move in a stock, a strangle can be an incredibly useful tool, even if you can't predict the direction. So let's go through an example. A trader doesn't know what direction Apple will go in, but thinks there will at least be some large moves. So they buy an out-of-the-money call for $7.88 per share, or $788 total. They then buy an out-of-the-money put for $7.55 per share, or $755. So they've spent a total of $1,543, and they're potentially risking it all if Apple were to stay between $285 and $295. If Apple goes over $310.43, the gains from the call would become more significant than the losses from the put, and the user would profit. On the flip side, if Apple went under $269.57, the gains from the put would be more significant than the losses from the call, and once again, the user would profit. While these break-even points seem pretty outlandish, the reward for breaking beyond them is very strong, as you would profit $1 for every penny past the break-even point. So if you can make money when a stock moves a lot, can you also make money if it doesn't move very much? And as you could probably guess, the answer is yes, and you may even suggest selling a call and a put, as this would be the opposite of a strangle. And while you are right, this is one way you could bet against a stock moving, it's a little bit inconvenient, as you would need to post both 100 shares as collateral and 100 shares worth of cash as collateral, and that could get pretty expensive. There's an easier and more convenient way of betting on a stock not moving, and it's called an iron condor. I purposely saved iron condors for last, as they're the highest level of all option combinations we'll be talking about. You first enter an out-of-the-money call credit spread. As a reminder, this means that you'll be buying a cheap call and then selling a more expensive one that is still out of the money. As a reminder, this spread profits when the stock stays the same or goes down. Then enter an out-of-the-money put credit spread, and as such, this spread profits when the stock stays the same or goes up. As a result of these two spreads, you will profit most if the stock doesn't move very much. So for this next example, you'll notice that I'm using a different price for Apple, and that's just because these videos take time and prices move around. I still want to stick to current real-world values, and it'll be nice to change it up anyway. So in this example, our trader is predicting that Apple will not go up or down, but instead will stay flat. So they first enter a call credit spread. They start by buying a $305 call and selling a $300 call. Remember, in order to sell the second call, they will be using the first call and $500 as collateral. Then they do the same with a put credit spread. They buy a $290 put and then sell a $295 put using the first put and $500 as collateral. Now remember, the order you enter the contracts in each spread is very important, so you have proper collateral, but the order you enter the spreads themselves doesn't really make a difference. So we're dealing with a lot of contracts now, so let's just sum everything up to see what we're working with here. They pay the $785 for the first call and receive $1,025 for the second, but post $500 in collateral. And then they pay $733 and receive $928 for the puts, but also post collateral. With all the scary numbers summed up, they're only depositing $565 to enter the position. I'll consolidate some of the info here to clear up space. Now the best case here is that Apple stays between $295 and $300, because then the trader will get their full $500 collateral back on both of their spreads, netting them $435 in profits. Now in the worst case, if Apple were to go under $290 or over $305, then the trader will lose the full $500 collateral on one of their spreads. Now since the spreads do not overlap, this is the worst case. There's no way the trader could ever lose the full $1,000 in collateral. As a result, the worst case for the trader is that they simply lose $65. You might be thinking that's a pretty small risk for such a large reward, but the reality is that Apple is a pretty volatile stock, especially at the time of making this video. A $5 span to hit the max gain is really small, and 1 month is a pretty long time. So the options market for Apple is predicting that it would be really unlikely for Apple to stay flat over the next month, which is why the payout is so high. So this is a good transition to the final segment of the video. How do you know if options are cheap or expensive? We spent a lot of time talking about strategies for how traders might make money in different scenarios, but how can you be sure that an option is fairly priced and the risk-reward ratio is really worth it? The answer is the Black-Scholes-Merton, or BSM model. This is basically just a math equation using some information about the stock and options to try and calculate a fair price. At the end of the day, the price you see an option trading at is just a product of people buying and selling, just like anything else, but the price points they pick are usually guided by this model. Now, this is still a beginner video, so I'm really only going to scratch the surface when it comes to this topic, but the basic idea of the model is that it's the solution to this partial differential equation. Now, there's obviously a ton to define here, but these are the basic solutions for calculating calls and puts. Things can get even further complicated if you consider dividends and American versus European options, etc., but I'll just focus on the basic variables for now. When you consider plugging these variables into the equation, things will start to make a lot more sense. You'll notice some things you might expect, such that the longer the time frame, the more expensive the option, the further out of the money, the cheaper the option, but most importantly, the more volatile the underlying stock, the more expensive the option. In fact, I want you to focus on just these variables for now. Volatility and market price of the option are the two most important variables, because they are the only subjective variables. Everything else is essentially defined. So these variables depend on each other and nothing else. You might be wondering, isn't volatility just something you can measure? Why would you consider it to be subjective? And while this is true, the key here is that we're referring to expected volatility over the time frame. Past volatility isn't necessarily a good indicator of future volatility, similar to how past price isn't necessarily a good indicator of future price. There's no foolproof way of predicting it. ACB is one of my favorite examples to illustrate this. You're looking at the 5-year chart right now, and you can practically split this chart up into 3 distinct segments. And this shows the innate problem with measuring volatility. It might be a terrible indicator of what's to come. It doesn't matter whether you're a bull or a bear on the stock. The one thing that isn't arguable is the fact that options are consistently underpriced. Anyone who has strangled this stock at practically any time has made a killing, as it continually redefines what it means for a stock to be volatile. For this reason, option traders have to be forward-thinking when considering what level of volatility is fair. For the example of ACB, it may have been harder to predict, but a more practical example would be to expect higher volatility in the future because you know an earnings call is happening. Which brings me to my next point, implied volatility. Just as options traders use volatility to predict fair prices, the rest of the market often uses option prices to forecast volatility. Before learning about options, I didn't really understand what the meaning of implied volatility was. I thought it was measured, not implied. But with any two-variable equation, just as you can use predicted volatility to price options, you can also use option market prices to calculate predicted volatility. Here, basically all I've done is gone through a few key stocks and looked up the at-the-money 1-month call price and plugged it into the BSM model to solve for what the option traders are predicting. Even if you're solely a stock trader, this can be a good practice for better understanding the risk of your portfolio. Nonetheless, nothing on this list should be too surprising. Market disruptors will typically have higher volatility and therefore more expensive options as a result, while large caps and especially bond ETFs will have lower volatility and cheaper options as they aren't expected to move very much. So that's it for the video. Hopefully there was enough here to help you understand the basics and maybe even use them to articulate your own positions. Just remember, all trading involves risk, and I wouldn't suggest anyone get started unless they have a strong understanding of most of the content in this video. With that said, if you have any questions, feel free to ask them in the comment section. And as always, please like and subscribe if you want to see more content like this in the future. Thanks, everyone.